Hi guys. So today we will continue on where we left off yesterday. So we continue with the questions, still dissecting the principles of consolidation. So we'll continue. There were about, I think, 1 or 2 questions left to do. So we will do that, and then we will, after doing that, then we will start today's lecture, which is the consolidation of a wholly owned subsidiary after acquisition. Okay. All right. So I'll share my screen now, and then we will begin. Guys, ask me any questions at any point in time. Right. It's very important that we ask ourselves questions here. You know, I expect you to have done your pre-reading for today. You've gone through the questions so that you can ask whatever you don't understand, right? Okay, so it's still going to be an interactive one. I'm going to ask questions and I expect you to give me answers, and you're also expected to ask me questions and then to provide you with feedback. Cool, so let's continue. So we look at this question, example 5, acquisition of a partly owned subsidiary at a premium. So this is a situation whereby we will end up getting what? A goodwill. So let's see how the goodwill arises. Let's see how the goodwill arises here. So I will put this question on the board, and I'll give you about just probably about 3-4 minutes to read through it and to think about it, and then we'll go through it together. Read through it, think about it. You can even do it. Jot down your answers. Jot down your answers. A statement of financial position has been given to you, and they want you to prepare the consolidated financial statement or the consolidated statement of financial position. Also try and work out the ownership interest. The ownership interest in the subsidiary. So we've been given the statement of financial position as at 31st of December 20.9. We have the assets, we have the liabilities, and the equity. Assets, equity, and liabilities. Property. So we have property, plants, and equipment. 160 for parent company, 160,000 for a subsidiary. There was an investment in the subsidiary. 64,000 shares were sold. Were purchased for 140,000 rand. Right? Trade and other receivables, 98 and 110 respectively. Then we have equity and share capital. Ordinary shares, 100,000 for parent, 80,000 for subsidiary. Retained earnings, 120,000 for parent and 60,000 for subsidiary. Then we have trade and other payables. Now we're supposed to prepare what? The consolidated financial statements. Remember, what we have been given under A is what has happened or what has been recorded in A's own financial statements. What you see and in B is what has been recorded in B's own financial statements. So these are individual financial statements that they are comparing like to like. We are now coming to prepare the consolidated financial statement, which is a different thing altogether, with its own journal entries. So the journal entry to prepare the consolidated financial statement are what is called the pro forma journal entries. So when you hear the word pro forma journal entry, these are the journal entries to prepare the consolidated financial statements. When you are dealing with the individual financial statement of A or B, a transaction between A and the subsidiary is a valid transaction. It's okay. We can record it. We don't need to eliminate anything. So with B. It's only when we are preparing the consolidated financial statement, that is when we have to eliminate intercompany transactions. Cool. All right. So yeah. So we determined that the interest is 80%. 64,000 shares were acquired out of 80,000 shares. So 64 divided by 80 gives us 80%. So it means that the parent has 80% interest in the subsidiary. Good. Let's look at the analysis. The analysis, you have 80,000 shares, 80%, so 64,000, and then 20% goes to the NCI. 20% of 80,000 is 16,000. Retained earnings, 48 and 12. Giving us a total net asset value at date of acquisition was 140,000. That's total. Out of the 140,000, 112, which is 80%, goes to the parent company, and 28,000 goes to the non-controlling interest. The purchase consideration, that how much the parent company bought the subsidiary, was 140,000. Was 140,000. So if you subtract the net asset value of the parent of 112 minus the 140,000, we get what? A goodwill of 28,000. That means we purchased more. We purchased a premium. We ended up paying more than the net asset value. Because normally, when you are going to purchase something, anything, you want to purchase what? You want to pay for the net asset value. Any amount that you pay over and above the net asset value is what? Is goodwill. Is goodwill. Now let me ask you a question. Why will a parent company want to purchase more than the net asset value? Because normally the 112 should be what you should pay for. Why did they decide, or why would they decide to pay more for a company? In this case, they pay 140,000. Why would they want to pay 140,000 when they know that the net asset value or the equity of the company is only 112,000? Why? Who can tell me? Why would they want to pay more? Why would a parent company want to pay more than the net asset value? Because when you are going to buy a company, you look at what the equity is or what the net asset value is, which is made up of, which you go to what? To the statement of changes in equity. But why would a parent company want to pay more? Just think about it. A parent is paying more than the net asset value of the company. Why? Why would they want to pay more for it? Why am I paying more for a company than what the company is actually worth? One of the reasons why a company may want to pay more or a parent company may want to pay more than what the value of the company is maybe the parent values the company more than what the subsidiary values it. So maybe the parent thinks that when they come in, when they acquire the company, they'll be able to make certain changes, to make the company to earn more profit, or to be able to have a better performance, and hence they don't mind to pay a premium for that company. Maybe they are bidding. Another reason is that maybe they are bidding with another potential investor. So this company want to pay more so that they'll be able to outwit the other candidate or the other investor. Maybe there is a revaluation that the subsidiary has not taken into account. Because remember, the net asset value is what is certain in the statement of financial position. That is the book value. But maybe the investor knows that this property, plant, and equipment actually is worth more than the amount that is certain on the statement of financial position. Therefore, I can afford to pay more for it. Because when this plant or property is valued, it's going to be worth more than the value that is certain in the statement of financial position. So those are some of the reasons why a parent company may end up paying more than what the net asset value of the company is. Okay, all right. Cool, let us continue. Then we get to the pro forma journal entries. We know what the pro forma journal entries are, right? We debit the share capital, we credit the investment, right? To eliminate, to cancel the transaction that took place at acquisition. In this case, not only did we didn't buy the shares only, but we bought what? The net asset value. What does the net asset value consist of? It consists of share capital and retained earnings. And so that is we bought into the net asset value. We purchased the net asset value and not the shares. So anything that is part of the equity at acquisition needs to be eliminated. And that is why we debit the share capital and we debit the retained earnings. Right. And of course, we credited the investment. So that, and yesterday we explained the reason why we eliminate, why the investment becomes a credit and why the equity or certain in the subsidiary becomes what? A debit. Because we are canceling the transaction, we are eliminating it. So whatever was a debit in the subsidiary becomes a credit in the pro forma journal entry, and then whatever is was a credit becomes what? A debit. I'm talking about at acquisition transactions, the share capital and the investment. Then we saw that this transaction at acquisition resulted in goodwill of 28,000. This goodwill that you have put down here is not an elimination entry. You are recognizing goodwill as an asset. As an asset. Remember, you, the parent, you value the company more than its net asset value. Therefore, the premium that you paid over and above the net asset value becomes goodwill to you. You think that you will be able to use the company to generate more money than what it is giving you now. And hence, the goodwill is an asset. So you debit the asset. So this goodwill here is not an elimination journal entry. You are recognizing the goodwill at acquisition. And then you also have non-controlling interest. Because you don't have, it's not a wholly owned subsidiary. You don't have 100% holding. There is a 20%, you have 80%. There is a 20% that is owned by outside parties or minority interest, or what we call non-controlling interest. These non-controlling interests hold 20% and they have to be accounted for. So this also is not an elimination entry. The non-controlling interest is not an elimination entry. This is what you are recognizing, that there is a non-controlling interest in this particular consolidation. So the only elimination entries are a share capital, retained earnings, and the investment. The goodwill and the non-controlling interest they are not elimination entries. They are recognition entries. You are recognizing them. Does everyone understand? Good. So and as you pass the pro forma journal entries or the adjustment, that means everywhere you see a share capital, you must debit it, right? So the first step in the consolidation is that what? You join them together. You join the assets, liabilities, income, expenses, equity of the parent and the subsidiary together. Then you perform the pro forma journal entries. Then the pro forma journal entries will now go in what? In debit or credit. So here, when we join together the share capitals of the two, we have to debit it by 80,000. When we join together the retained earnings of A and B, we need to debit by 60,000. When we need to goodwill goodwill never existed. So it's not like we are adding the goodwill of A and the goodwill of B. No, goodwill never existed. This is the first time we are recognizing goodwill. So goodwill will exist on its own as a debit of 28,000, recognizing the goodwill. Then we have the investment, right? 140,000 plus 0. And then you credit it. So the investment will be out. Investment value will be out, to be 0 in the statement of financial position. Then we have the non-controlling interest. This is the first time we are recognizing the non-controlling interest. So it will be what? A credit balance of 28,000. So first stage, join them together. Add A and B, add them together. Then, based on the pro forma journal entries, you debit the account, or you credit the account. Then you record the balance. That is as easy as that. Nothing complicated. Easy stuff, guys. Nothing complicated. Any questions so far on what we have done? Any questions? Will you be able to do your assignment based on the knowledge you have? Do you understand the principles? At the start of what we are doing today, there's a quiz which is testing us. Not like it's not, you don't do it individually. We discuss it as a group, but there's about, I think, 7 questions, just for us to be able to put everything we have learned together to solidify our knowledge and our understanding. When it comes to consolidation, the more questions that is posed to you, the more you think about it, and then it begins to make sense. As you answer these questions, they begin to open your mind. They begin to now you begin to understand things more. So those short quizzes will help us to first of all, in terms of revision, and also to make concrete our understanding so far. Okay, so just bear with me. Let's go. Just follow me little by little. We will get there. Cool. So then we now have to prepare our consolidated statement of financial position. Like I said, when you have in an exam, or when you do your assignment and you are asked to prepare statement of financial consolidated statement of financial position, you start off by having a skeleton, a structure, property, plants and equipment. You put in 160,000 for company A plus 160,000 for company B. Then you write the total 320,000. Then goodwill is an asset, 28,000. You know how we got the goodwill. Then you come current asset, trade and other receivables, 98,000 for company A, 110 for company B. We close the bracket. Why? Because there was no other adjustment per the pro forma journal entry. There was nothing that affected trade and other receivables. So because of that, we end the transaction there. 98 plus 110. We close the bracket. That is it. And all these things are marks. These are all marks. As you put them, we are marking you. We mark you. We mark you because you are preparing the consolidated financial statement. At the end of the day, we should see what a combined statement of financial position. So if you waste your time doing calculations and you are not able to translate your calculations to the end product, to the statement of financial position, is 0. You will get nothing. That is why the exam technique is that once they ask me consolidated, I need to put down something in order to get marks. Join the two together, combine the two, the assets, liabilities, income and expenses, and equity on a line-by-line basis. That you are earning marks. Good. Then we come to the equity share capital. Why is share capital 100? Share capital was 100,000 for the parent company, and I think it was 80,000 for the subsidiary, if I'm not mistaken. Let me see. It was 80,000 for the subsidiary, but then from the pro forma journal entry, we debited 80,000. So this here, the complete answer for the share capital becomes 100,000 plus 80,000 minus 80,000, giving me what? 100,000. So that is why my share capital is 100,000. So the first instance, we combine 100,000 from A, 80,000 from B. Then because I debited it, I debited share capital in my pro forma journal entries, I come and do what? I subtract 80,000 from it. The reason why you are performing the pro forma journal entry is for you to make adjustment in these numbers here. Therefore, I end up with 100,000. Retained earnings, you start off by combining the two. The retained earnings of the parent was, cannot remember. The retained earnings was 120,000. So you say 120,000 from A plus 60,000 from B. Then from the pro forma, you debited 60,000. So because of that debit, you have 80 plus 60 minus 60, giving you, you have 120 plus 60 minus 60, giving you 120,000. That is why retained earnings is 120,000. So we started by combining the two, 120 and 80. Then because of the pro forma journal entries, we have to deduct 60 from it, leaving us with 120,000. So these numbers are not magic. It is as a result of the pro forma journal entries. And the fact, so we started by, so we combined them, and then the pro forma journal entries made that to subtract. Good. All right. So it's the pro forma journal entry that helps you to prepare your financial statement. But when you get more into the advanced stages, you realize that you don't even need to prepare the pro forma. You know it by heart. It's in your head. But we will get there little by little. Then create another payables. So 170,000. Yes.
Gordon, sorry to interject you. There's a hand from Masote.
Oh, okay. Sorry, Masote. I'm very, very sorry. Sorry. Please ask your question.
So just on the retained earnings,
yes.
You said 120 plus 80 minus 60. It gives 140 and not 120. I don't know if maybe I've missed anything.
No, I made a mistake. 120 plus 60 minus 60.
Oh,
yeah.
Okay.
And where is the 120 coming from? It's from A. It's from the parent A. Where is the 60 coming from? It's from B. Where is the minus 60 coming from? It's from the pro forma journal entry that we said debit. So because you are debiting share capital, you need to what? To cancel out. So it becomes 120 plus 60 minus 60, giving you 120,000. So your end result, your consolidated financial statement is made up of the joining plus the pro forma entries. Do you understand? It's the joining together, adding A and B together, and adjusting it with the pro forma journal entries. Okay, cool. And that is it. Trade and other payables. So trade and other payables in our pro forma journal entries, there was nothing. We didn't pass any pro forma journal entry for trade and other payables. So there's no other adjustment other than add A and B together. Add company A plus company B. That's 170,000 plus 130,000, giving us 308,000. You get it? So the principle, always keep it simple. Keep it simple. If I'm asked to prepare a consolidated financial statement, I need to get marks. Where do I get the marks from? What is the starting point? I join them together. Because I'm preparing consolidated financial statement of a subsidiary. I join them together. When later on, when we start to prepare associates and jointly controlled, we will apply different principles. But for now, because it's a subsidiary, we add together. We add together, and then we make adjustment. Whether we add, we subtract, or we plus based on the pro forma journal entries that we have passed. Cool. All right. Then the last question to do for the day. Example 6. Cool. So as I was saying, let me give you two minutes. Just read the question and jot down things, like start calculating the controlling interest and start looking at what will I eliminate, you know. Start, let it sink. Read the question, try to make sense of it, try to understand it. Then ask me any question before we start looking at we start tackling the question. So before we start tackling the question, read the question and ask me questions. Something you wouldn't, there may be something you don't understand. Like, God, how do we do this? Oh, I see this. How will I account for this? You know, just think about it. Let it sink. And that is the learning process. So it doesn't help if someone talks you through, but you sitting down, being able to make sense, it really helps a lot. Okay, so let's look at it together. So in this case, let's read it. So whenever you get a consolidation question, read the question and underline certain key things and let the question make sense to you. For example, P Limited acquired interest in S. So who is the parent company and who is the subsidiary? That's the first question. Who is the parent company and who is the subsidiary? Is it P or is it S? I mean, first of all, who is the parent company? Anybody? P.
Ltd.
Yes, P is the parent company. Oh, good. Thank you so much. Thank you so much. So P Limited acquired interest in S. So P is the holding company or the parent company. That's the first thing. When did they acquire it? When is the acquisition date? The date that it acquired. Very important. So the things you must note: who is the acquirer, which is P. Who is the subsidiary? Is S. When did this transaction take place? On the 30th of June 20X5. In accounting, dates are very, very important. If you miss the date, you miss the transaction. Very important. So P, the parent, acquires subsidiary S on the 30th of June. Then they tell us that each share carries 1 vote. So each share is 1 vote. That's fine. The following represent the condensed trial balance. All the exercises we have seen so far, they are all what? They are all financial statement of financial position and whatever. This question is telling us that what we have the condensed trial balance. Do you know what a trial balance is? You just got balances. You have not prepared the financial statements yet. So you have debits and credits. You have property, plants and equipment, investment. So you have the balances in the trial balance, but you have not prepared what? A financial statement. And that is why you see them as this. They don't look like a proper financial statement because they don't comply with IAS 1, with International Accounting Standard 1, in terms of how a financial statement should look like. This is a trial balance, so they can afford to say debits and credits. These are all the debits, these are all the credits. But they still give us all the information we need to prepare our consolidated financial statements. We have property, plants and equipment. We have investment in S, the amount. 75,000 shares were bought out of how many shares? Out of 100,000. So we know our controlling interest. There was, in addition to that, P also has 10,000 debentures. So debentures is also an investment in a company. So you can actually acquire an investment in a company 2 ways. Either you buy shares or you can also buy what is called debentures. So debentures are like an asset that you acquire that they pay you interest or probably it can be on a yearly basis or a monthly basis. And at the end of the term of the debenture, the company that issued the debenture will pay you back. will pay you back. So it's like the company who issued the debenture has issued a loan, has gotten a loan from you. So instead of the company S getting a loan from the bank, they issued a debenture to the public. It works like a loan. So the holder of the debenture will give them money. Because of that, S will be paying them interest. Then at the end of the term of the debenture, maybe 5 years, 10 years, the debenture issuer will pay the money back to the holder. Right? So P has two investments: investment in shares and investment in debentures. Good. Right? The investment in debentures does not affect our controlling. It doesn't affect our control in anything. It's just a normal investment that I've made. Probably it was a 5% investment, 2% investment, 1% investment in some company. I don't care. It doesn't affect my shareholding in a company. Good. The only one that affects is the 75% shares I bought in S. Then there's the bank. Then there's inventory. Then there is share capital, 150 and 100,000 shares, retained earnings, debentures, debenture of 20,000. So as P Limited has recognized a debenture asset, S Limited has recognized a debenture liability. You see, liability. That means P bought some debenture investment in S. The fact that P's investment is 10,000, but the loan is 20,000 means that S also issued a debenture to other companies. They issue 10,000 to P, and they also issue another 10,000 to other companies which we don't know of. So they've recognized a liability of 20,000 in their books. Trade and other payables 8.8 and 1.2. Then bank overdraft 5,600. Will you all be able to prepare the consolidated financial statement from this information? Is there anything that doesn't make sense? Is there anything that is difficult that you think I'm not getting? That I will not be able to prepare the consolidated financial statement? Anybody? Is there a line item that you don't know what it means? Maybe you haven't met it before. Everyone is sharp. Good. So the first stage, what is the first stage of preparing consolidated financial statements? What is the first step?
Having to add the amounts that we have under the trial balance.
Good. So add the amount for company A and company B. Good. What is the second stage? What is the second step?
Eliminating intra-group transactions.
Good. Eliminating intergroup transaction through what? A pro forma journal entry. Once you know these steps, guys, you are done. So always have it at the back of my mind. Like if I'm asked to prepare a consolidated financial statement, two things. I'm combining, I'm eliminating through a pro forma journal entry to get my end results. If I know this, believe you me, you will score minimum 60%. Oh, even, what am I saying? 75. Distinction. I promise you. Just knowing what it means, what you need to do would give you a distinction. Just knowing that. Because what is so difficult about adding 10,000 plus 20,000? Adding a property, plant and equipment 52,700 plus 133,900. What is so difficult about adding a bank of 2,500 plus 0? What is so difficult about adding inventory 15,800 plus 4,800? What is so difficult about adding trade and other payables 8,800 plus 1,200? What is so difficult about adding retained earnings 12,000? I mean, And every single thing you do, we mark it. We are marking. We are marking, just combining. Then after you have combined, you say to yourself, okay, the next step is to eliminate intercompany transactions. Before you even start the answering the paper, do you see intercompany transactions here? Just tell me what you see. Do you see intercompany transaction in this question? Tell me some of them. Tell me the ones you are going to eliminate. Yes, which ones will you eliminate? Debentures. Good. So Melody said you will eliminate the debentures. Oh, excellent. Excellent. Because you have a debenture liability of 10,000 and you have a debenture asset of 10,000. Right? So the portion of the debenture, that is, so it means that the parent has got 10,000 here, right? So when you come to eliminate, even though you see a total of 20,000 here under the credits, you only eliminate 10,000. Why? Because you only eliminate the transaction that you have with your parents, not with other people. Other people you don't care. So you only eliminate the 20,000. Sorry, the 10,000 inside this 20,000, because that is a transaction that you had with your holding company or with your parent. Why? Because when P acquired the debentures, the journal entry, but who can tell me the journal entry that P passed in their financial statement when they acquired the debentures? Who can tell me? Who can tell me the journal entry that P would have passed in their financial statement when they acquired the debentures? What did P debit and what did they credit when they acquired the debenture investment? I want the journal entry and I want the amount. What did P pass in their own individual financial statement? What journal entry did they pass to record the acquisition of the debentures? Good. Debit bank. Yeah. So debit investment or debit debenture assets. Debit debenture assets of 10,000 and credit bank of 10,000. Excellent. That is what P would have done in their own individual financial statement, in their own books. Now, what journal entry will S will have passed in their own financial statement or in their own books? What journal entry would they pass? So now we know the one for P. P will say debit debenture asset 10,000, credit bank 10,000. What about S? What will S do? What journal entry will S have passed in their books? Good. Melody said debit bank credit debenture. Good. It's good. Because why? They sold it. I mean, they issued it for money. So they will debit bank. Good. So S will debit bank and they will credit a debenture loan. The fact that you have got you've gotten the money, but the money you just got access to it, but it's not yours. After 5 years, 10 years, you are expected to pay it back like a loan. So you credit what? S will credit what? Debenture loan. Good. Of how much? 10,000. So you see, so as we advance in consolidations, right? Every time you go to maybe third year, fourth year, every time they ask you to give them the consolidating or the pro forma journal entry, the trick is that let me pass the entry in the holding company and pass the entry in the subsidiary and eliminate the two. That is the trick, and that is the secret. Many people, about 90% of people don't know this. So all you need to do is that pass the entry in the holding company, pass the entry in the subsidiary, and eliminate the two. Whatever what is a debit, make it a credit, and whatever is a credit, make it a debit, and you are done. 10 over 10. You see, good. So that's how it is. So because P said debit debenture 10,000, credit bank of 10,000. S said debit bank of 10,000, credit debenture of 10,000. My pro forma journal. So what will my pro forma journal entry become? What will be the journal entry to eliminate it? Now I'm eliminating it. I'm preparing a pro forma journal entry. What is that journal entry? Which is going into my consolidated financial statement. What is that journal entry? What is my pro forma? Whenever I say pro forma, it means that I want the journal entry for the consolidations. And what does the consolidation require? Elimination. Consolidation always requires what? Eliminate the intercompany transactions and combine the other amounts. Okay, so okay, I like what you have done there, even though it is not 100% right, but I like the answer that Masoti has given, so that we can all learn from this. You see, bank is always a balancing figure. So whenever you are preparing the consolidated financial statement, just leave out bank. Look at the other elements. Look at the debentures and look at the loan, but leave out bank. I mean, that's whenever you are preparing the pro forma journal entries. When you are preparing the individual financial individual journal entries in A and B, yes, bank is involved. Debit this, credit this, debit bank, credit bank. When you are preparing the consolidated financial the pro forma financial statement, just leave out bank, right? So in this case, it's going to be what? Debit debenture and credit investment. That is it. That is it. Norma, thank you. That is it. So in my pro forma journal entries, I'm debiting debenture of 10,000. I'm crediting investment of 10,000. That is it. So every time, so put this somewhere, stuck it somewhere in your mind. Every time you are asked to prepare a pro forma journal entry or to eliminate an intercompany transaction, always do write it down. What will the parent company have passed in their books? What will the subsidiary would have passed in their books? Now eliminate them. Make the debit a credit and make the credit a debit. You are done. And this is going to be consistent as we go along. From today until you those who are going the CA route to write the board exams, it is the same principle. It will never change. The same thing. What did P do? What did S do? Turn it around. That is your answer. Okay, good. Let's carry on. So we continue. Good. Yeah. So basically, yeah, we can go down and look at the solution, but I think I just wanted us to understand the principle. I just wanted us to understand the principle. So, okay, so we asked a question that what are we going to eliminate? So we a lot of people said debenture. Is there any other thing that we can possibly eliminate from here? From this question, apart from the debenture, what else are we eliminating? So in the question that we were just looking at, what apart from the debenture, is there any other intercompany transactions that we need to eliminate? Equity, good. We eliminate the equity as well, and the investment, right? Good. So we debit equity, we credit investment. We credit investment, and that is what is called an acquisition journal entry. Good. Excellent. Okay, So we've done a lot, we've spoken a lot, we are still learning the principles. And I think the principles are becoming clearer now. So that the more I repeat myself, the more I say it over and over again, I think you seem to get it. And it's going to be consistent, whether it's from second year up to the honors level, it's the same principle, it's the same procedure. They can write a whole lot of sentence, but it's the same principle, it will never change. It's the same thing. What did P do? What did P do? What did S do? Let me turn it around. Then that is my pro forma journal entry. At acquisition, it's the same thing. I don't even know. It's the same thing. Cool. Right. So we are done. We're done. And because we are about 90% of what we are speaking about in this first 1 hour is the same principle we're going to be discussing to finish off study unit 4. So I'll switch on to study unit 4 now. And then, okay, so I have my notes for study unit 4. Good. So these are my notes for study unit 4. So study unit 4, now we've looked at preparing consolidations at acquisition and all that, but now we are going a step further. Now we are looking at consolidations of a wholly owned subsidiary after acquisition. So now, after all the transactions, all the consolidation we've done so far are what? Our transaction that has happened or consolidation that happened at acquisition when we bought the subsidiary, Now, what happens after you bought the subsidiary? What are the pro forma journal entries? Yeah, after you bought the subsidiary, the companies are going on. The whole parent company is operating on its own. Subsidiary is also operating on its own. They are all earning income. They are earning dividends. They are selling. They are buying. They are selling. What are the pro forma journal entries subsequent to the acquisition? Subsequent to acquisition or after acquisition? What are the journal entries? Or how do we account or how do we consolidate? It's not difficult. Same principle. Easy as ABC. But you need to listen attentively. Good. So before we do that, there's some quiz here that I want us to go through these quizzes and let's learn before we proceed. It makes our life easier. Good. So the first question. What is the difference between a company-owned financial statement and a consolidated financial statement? Who can tell me that? What is the difference between a company's own financial statement and a consolidated financial statement? What is the difference? What is the difference? Anybody? The difference between a company's own financial statement and a consolidated financial statement. Whenever you open an annual report, you have both there. You have, okay, so Masoti said, consolidated statement represent a group. Good. You are right. And the other one, a company's own financial statement. What about a company's own financial statement? What is it? So you are explaining to me the difference between a consolidated financial statement and a company's own financial statement. What will I see in a consolidated financial statement that I will not see in a company's own financial statement?
A company's own financial statements will be just for the single entity and not be joined with any other company.
Good. Good. And then the consolidated will be joined with other companies, right? Good. So from what we have learned so far, from what we have studied, and now we are doing study unit 4. Give me an example of an item that you are likely to see in a company's own financial statement that you will not see in a consolidated financial statement.
Please repeat the question.
Yes, thank you. So based on what we have done so far, what we have studied so far, I think it becomes clear that there are certain items that I am more likely to see, right, in a company's own financial statement that I will not see in a consolidated financial statement? Can you give me one example? Based on what we have studied so far.
You might not see non-controlling interests in the company's own financial statement, but you'll see it in the consolidated statement.
Excellent. Norma, 100%. Excellent. Good. You will see a non-controlling interest in the consolidated financial statement, but you will never see a non-controlling interest in the company's own financial statement. Good. What else? Think about the things that we have eliminated. Melody says two bank balances in a consolidated financial statement. No, you will see bank balances in a consolidated financial statement, because remember, consolidated financial statement, you are adding the assets of the parent and the asset of the subsidiary. So if the asset has got a bank of 40,000 and the subsidiary has got a bank of 50,000, you join them together, you get 90,000. So you see a bank. What else? Apart from non-controlling interest, what else? Think about the things we have eliminated.
Hello, sir.
Sorry?
I just wanted to say there are two bank balances. You can either see an overdraft or a positive balance. Whilst in a single entity, you can just see maybe one bank balance. That's what I wanted to say. But sometimes the bank balances can be, one can be negative and the other can be positive. Because I understand that in the consolidated, you don't cancel off like the balances, the bank balances.
Okay, so are you saying that in a consolidated financial statement, I'm more likely to see a debit bank balance and a credit bank balance being an overdraft, but in my own financial statement, I will not see those two?
Yeah, that's what I think, boss. In a single entity, the balance can either be negative or it can either be a credit balance or a debit balance. But in a consolidated financial statement, the balances, you can see a credit balance as well as a debit balance on the statements.
In both companies, in both companies' own financial statement and consolidated financial statement, you will see both. You are supposed to actually remember the fundamental use of a financial statement, whether consolidated or own financial statement, is to give the users of the financial statement an information for them to be able to make informed decisions, right? So if you end up netting your overdraft with your bank, there are certain instances that the IFRS does not allow you to net it off. You're actually supposed to show overdraft and you're actually supposed to show bank, both in your company's own financial statement and also in the consolidated financial statements. It's only in certain in certain very rare occasions, but even that, you might disclose it in your policy that you have an enforceable right to net off bank a negative bank or bank overdraft with positive bank balance. So in both consolidations and for your own financial statement, you will see both. You will see both. Okay. There's been a number of other things. So let's see. A company's own financial statement is for a single entity. Okay. Intergroup sales, loans. Okay, good. So in consolidated financial statement, because we have eliminated the intercompany transactions, we don't expect to see intercompany loans, intercompany sales, right? Because we have eliminated them. But in our own financial, individual, own company financial statement, we will see them. we will see a loan to a subsidiary, an asset from a subsidiary, a gift from the holding company. Whatever, we will see it. But in the consolidated financial statement, we won't see it. Why? Because we have eliminated them. And so that is a concept I wanted you to have. That first of all, there is your own financial statement, which you can have a transaction with your holding company, with your parent company or your subsidiary. It's fine. But when it comes to the consolidated financial statement, certain items, you will not see them because we have eliminated them. For example, in my own company financial statement, I will show investment in subsidiary, 40,000. But I cannot expect to see investment in subsidiary 40,000 in the consolidated financial statement. No, because what? Because I've eliminated it. But in my own individual financial statement, yeah, I have to have it. Investment in subsidiary, 100,000. It must be there. Because in my individual financial statement, that transaction is a valid transaction. It's only supposed to be eliminated when I prepare a consolidated financial statement. So that pro forma journal entry that you process, it's a journal entry that you process on a yearly basis. You start from scratch. You start all over again. Every year you pass that journal entry until the company until it's no longer a subsidiary. You pass it every year. It's a separate journal entry you pass only for the purpose of consolidations. You don't pass pro forma journal entries in your own financial statements. No, only for consolidations. Good. Let's move on. The next quiz. In which statement do you eliminate intercompany transaction, and in which statements do you eliminate intercompany transactions and balances? Oh, okay. So we eliminate them in the what? In the consolidation. Okay, don't worry about that. Mention 4 items we eliminate when preparing consolidated financial statements. Mention just 4 items that we eliminate when we are preparing consolidated financial statement. What are they? What's the first one? 4 items, only 4. The first one. What item do we eliminate during consolidations? Anyone? Just mention any. Profit. You're supposed to mention 1, then somebody else will mention 1. But anyway, profits, sales, loans. Good. So Masoti has mentioned 3 for us. So we only have 1 left. No, don't worry about it. Don't worry about it. So Masoti has mentioned profits. Yes, intercompany profits, intercompany sales, intercompany loans. What else? We have 3. 1 more to go. All these things are going to have a very direct on what we are going to be doing today. Equity in subsidiary and the investment. Good. Excellent, guys. What is the difference between a partly owned and a wholly owned? What is the difference between partly owned subsidiary and a wholly owned subsidiary? Fast and quick. You can tell me, then we move on. Difference between partly owned and wholly owned. 100%. Which one is 100%? The partly owned. Okay. So which one is that? Oh yeah, wholly owned is 100% ownership. Good. So wholly owned is 100% ownership. Partly owned is any other percentage other than 100%, right? Like 80%, 90%, and so on. Good. If I have a 51% interest in a company, do I control the company? If I have a 51% interest in a company, do I control the company? For the purpose of this course, do I control the company? Masoti says no. Any other answer? And explain to me why. Yes. No. Norma says yes. Norma says yes. Yes, Akani says yes. Okay, yeah. So yeah, when you have more than, according to for the purpose of this this module, when you have anything more than 50%, we assume you have control. Even though when you get to third year and fourth year level, when we start looking at delving into the meaning of control, we will see that sometimes you can even own 1% and still have control. But for the purpose of this module, anything 50% and over, 51.1, 50.0, anything above 50% is control. Is control. Good. At the date of acquisition, what does a parent company buy into? At the date of acquisition, what does a parent company buy into? What do they buy into? Do they buy into the assets? Do they buy into the shares? Do they buy into the, what do they buy into? At the date of acquisition, the parent company, what did they buy into? Okay, thanks, Melody. Yeah, what do they buy into? Good. So MC is saying, Melody is saying you shares or equity. You buy into the shares or the equity. Good. Good. And yeah, so yeah, and equity comprises what? Equity is a big thing. Equity comprises shares and retained earnings and revaluation surplus and all that, right? So the big word for them is we say you buy into the net asset value. The net asset value. The net asset value. So that if at the date of acquisition there is a retained earnings and there is shares and there is revaluation surplus, those items in the statement of change in equity, that is what you buy into. So far, it's because we haven't had any example which has got retained earnings and revaluation surplus and non-distributable reserves and all that. That's why we are only looking at shares. But when you are going to buy a company, you buy into the net asset value, which comprises the shares, the retained earnings, the revaluation surplus. If there is a share premium, whatever, these days share premium is outdated, and so on. So that is what you buy. In. So bear that in mind. Not only the shares, but whatever equity that existed on the date of acquisition, that is what you buy into. You buy into the net asset value at the date of acquisition. Whatever is there, revaluation surplus, retained earnings, equity, share premium, non-distributable reserve, whatever that equity is, you buy into that. Good. What is goodwill? What is goodwill? Anybody?
It is the amount in excess of the net asset value.
Good. The amount that you purchased in excess of the net asset. Excellent. Excellent, Masoti. Thank you so much. So that is what goodwill is. You have a net asset value of the company of, let's say, 100 million, comprising the shares, the retained earnings, the revaluation surplus, whatever. So under normal circumstances, you are supposed to what? To pay 100,000, because that's the net asset value. But you decide to pay 120,000. That 20,000 extra is goodwill. That premium that you bought over and above the net asset value is goodwill, because you think that the company is worth more to you than what the net asset value is. So that worth more, whatever it means to you, whether it means good management, it means bigger machinery, it means a brand name, whatever it means to you, why you decide to buy and you decide to pay a bigger amount, that is goodwill, and it's an asset. Good, because you can use it to generate income. Right. What will a company want to pay? Okay, we've already discussed that. Why do you think we reverse the equity and the investment at acquisition pro forma journal entries? Why do you think we do that? Why do you think we reverse the equity and the investment at the acquisition pro forma journal entries? I may not answer this question now, but I just want to understand what you think. We have been doing it, but do you really understand why we do it?
I think it would be an overestimation of the actual equity of the company. So it would be an inflation, so to say. So hence we need to eliminate the intergroup equity so that what you actually have is what you have, not an inflation.
Okay, you have said a lot of things. So our inflation, can you break it down for me? Why would it be an overinflation?
Let me not say let me say an overestimate. You overestimate.
Overestimate. Okay. Why would it be an overestimate? That is the
Because
core.
you as it said, you don't want to look like you're doing business with yourself, because you cannot owe yourself and pay yourself, and so that's why we eliminate to reflect the correct amount.
Okay, so we eliminate to reflect the correct amount. Correct amount of what? I am probing this. I'm asking the why because I want you to think deep. That is why I'm taking you very deep. I'm taking you deeper. The correct amount of what? But if we don't answer it today, it doesn't matter. You will for now. It's okay. Just eliminate it. But okay, maybe let me say it here. Maybe for the benefit of someone, even if you forget, it doesn't matter. But at least let me say it. Okay. So what happens is that whenever you acquire a company, right, you are actually bringing the assets and the liabilities and yeah together, right? You are bringing them together, and at the same time, in the holding company, you've also recorded debit and investment, right? This investment that you have said debit, if you don't eliminate it, it means that you are double counting. First, you are bringing in the assets, and you're also bringing in an investment. You understand? Because that investment that you have is actually that net asset value. And net asset value comprises what? Asset less liabilities. So if you are bringing the asset, if you are bringing all the asset and all the liabilities, and also you have an investment, you are double counting. Don't worry about it. We'll get it. Let's move on. Let's start. Good. So we know the accounting principle, accounting for groups, A limited and B limited. We add them together. We make adjustments and we call it group consolidated financial statement. These adjustments are what? The pro forma journal entries. Good. Now let's look at something here. Listen attentively. This is very, very important. Before a company, make it bigger. Before a company, right, a parent comes to acquire a subsidiary, right? The subsidiary will already be in operation, right? And as a result of the operation, they will have acquired their own assets, their liabilities. They will have acquired retained earnings. They will have acquired income. So they will have things, you know, equity, retained earnings, whatever, sitting here before you the parent company, you came to acquire them, right? Then when you acquired them, so this brown line where I'm showing, that is the date of acquisition. Consolidations only want to account for the things that you acquired subsequent to acquisition. So any other thing, so on here, where the brown line is, any other things that the subsidiary already had before you came to acquire it had to be eliminated. Why? Because they are not yours. They don't belong to, they don't form part of the consolidation. Otherwise, it will not be fair. Because before you came to acquire me, I had retained earnings as a result of all the accumulated income that I've had over the years. I had revaluation surplus. I had equity, or I had net asset value that is not that I had, you know, before you came to acquire me, right? So, and then after you've acquired me, then after you have acquired me, then we started earning more income, we're generating our revenue, and so on and so forth. Consolidations only want you to acquire for the things or the revenue or the income or whatever that you've not the we are not talking about assets and liabilities. Those are different. But when it comes to the earnings and the retained earnings and the profit, we only account for what the things that happen subsequent to acquisition. Subsequent to after what you have acquired me. Right, because otherwise otherwise the users of financial statement will not be able, it will not reflect a correct value. Imagine if I'm a company and I've been making so much retained earnings and income and whatever, and then when P came to acquire me, I include in the consolidated financial statement all the things that I have, all the revenue and all the retained earnings that I had prior to you coming to acquire me. It will not show to the users of financial statement how the combined entity has performed after acquisition. Because the things that you came to meet, they are not part of the parent company. The parent company did not take part of, they did not take part in acquiring those income. So they must not be part of the consolidations. We only show item income and expenses and retained earnings that happen subsequent to the parent company acquiring me. Do you understand? Because of that, we have like 3 different levels. We have before acquisition, which is shown by this first area ending by the brown line. Then we have at acquisition to the beginning of the new year, and then current year. Does that make sense? So before acquisition, the retained earnings and the income, they are not part of the group, because these were acquired by the subsidiaries alone. The holding company didn't take part, so they don't form part of the consolidations. Then from the brown line up until here, up until the end of acquisition to the beginning and these are the retained earnings that I must show in the consolidated financial statements. From date of acquisition to the beginning of the new year, Then from the beginning of the new year up until where I am currently, that is the current period. Maybe this is a bit complicated. I'm pausing for questions. Show by hand. I'm prepared to repeat over and over again. It is very important. Very, 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 very important. So there are 3 stages of a consolidation, or if you look at the life cycle of a subsidiary. There's a period that the subsidiary was on its own, doing its own business, acquiring its own income, and resulted in retained earnings before P came to acquire the subsidiary. When I am reporting for the consolidated financial statement, those periods that the parent did not take part, right, to bring the retained earnings or the income, that does not form part of the consolidations. There were a period that was earned only by the subsidiary. The subsidiary, though you cannot include it as part of the statement, the financial statement of the consolidations. Right. Rather, from the period that the parent company acquired the subsidiary to the beginning of the year, we call that period what? The retained earnings. And that formed part of the consolidation, because it was from the time that the parent acquired the subsidiary to the beginning of the new year. Then from the beginning of the new year to where I am right now is my current year. Does this make sense? I tried to explain it by that diagram to see from this time to this time. Maybe this one should be before acquisition. So there's before acquisition. This before acquisition it doesn't form part of the consolidations. Then this side, at acquisition to begin of the year, this formed part of retained earnings of the consolidations. Then the current period, from the beginning of the year until now, is the current period. Does this make sense? Show by hand, whoever it doesn't make sense to. Whoever it doesn't make sense to, like I'm talking Chinese.
I've got a question.
Yes.
So in the event where I understand what you're meaning, that when the subsidiary was acquired in operation, and they found it in operation, and then they acquired, then they will take out whatever they did before it was acquired. But now, in the events where the parent acquires it in the middle of its own financial year or the middle of the subsidiary, because that's where my confusion is, because the subsidiary could be now within, it's been acquired in that financial year. If the financial year starts in January and then it's acquired in June, so it will be then from June, maybe June the 1st to the end of December. Is it the financial year end of the subsidiary or of the parent? I don't know if you understand what I'm asking.
I understand you clearly. So what is going to, so what happens in real life? What happens is that when a parent company is about to acquire a subsidiary, it's like everything must stop. Everything must stop, and then we do calculations. We do everything that we have acquired. It's like we prepare a whole financial statement on the date of acquisition to show, because remember, a company will not, no parent company will come and buy a company without asking for the financial statement of the subsidiary. So if I'm the investor and I'm coming to buy a subsidiary, I'll say, hey guys, I want to buy this company. I want you to give me the financial statement as of today, the 25th of October. Where do what is the current position of your company? So the accountants and whoever, they will prepare the financial statement, the balance sheet, the income statement, the statement of changes in equity, and calculate the net asset value at today. So there will not be confusion, because we will get the value today, the net asset value today. So from today up until going forward, that is what forms part of the consolidations. You understand? So they will not even apportion. They will not say, oh, okay, it's a whole year. You have come to purchase me in the middle of my financial year. Let me apportion. No, you stop. You do a balance sheet, and you do a statement of financial position and statement of profit and loss and other comprehensive income, statement of change in equity. You do cash flow statement at today. Let's say the company is come to acquire you today. You will do the financial statement today, and you will tell us where you stand. And based on that, the investor will come in and buy, and then you determine whether we have a goodwill or not, based on whether I purchased over and above your net asset value, or I purchased below your net asset value, which be a discount, and so on. Do you understand? So on the date of acquisition, financial statements will be prepared, and from that date onwards, everything that you earn becomes part of the group. Does that answer your question?
Makes sense. Thank you, sir.
Thank you. Thank you for thanking me. Any other questions? Any other questions? Okay. Good. Guys are smart. Let's continue. What did I say? What acquisition date? Acquisition date is the day that we acquire the control. Good. Okay. So that brings me to the. So I wanted to have the quiz for us to juggle our memory, for us to be able to make get the understanding right, because we are moving, guys. Every day we are moving forward. We are getting more we are going deeper into consolidation. So just follow. Good. Cool. So now let's tackle this question. Acquisition of a wholly owned subsidiary. So now we've moved from a partly owned, now we are doing what? A wholly owned subsidiary. Subsequent to acquisition. So let's look at this. Read this question. Digest for 2 minutes. Read this question. I'll take it down as we read. So read this part. I'll take it down. We read the other part. Who means? Okay. So let's look at this question. Let's analyze it. Let's analyze this question. The following are the abridged statements of financial position. When you read a question, every sentence is important. Every sentence is important. The following are the abridged statement of financial position. So in this case, it's not a trial balance. It's the statement of financial position has been prepared. That means, as far as A and B are concerned, these are their financial statements. They've gone through journal, they've gone through a ledger, they've gone through a trial balance, they prepare financial statement, they pass the closing entries, whatever. They've done everything. Now they are financial statements of A Limited and its subsidiary. So we have A Limited and its subsidiary B Limited as at 31st December. So this is the statement of financial position as at 31st of December 20XX. The dates are very important. Who owns whom is very important. You underline those things. A is the parent, B is the subsidiary. This is the financial statement as at the 31st of December 2026. Good. We have assets, property, plants, and equipment, 160 and 180. Investment in B, 80,000 ordinary shares. It cost me it cost the holding, the parent company 124,000. We know from the equity and liabilities, we know that the subsidiary has got 80,000 shares. So what is the percentage holding? What percentage does the parent hold in the subsidiary? Based on what you have seen now, 80,000 ordinary shares were acquired out of 80,000. So what is the percentage holding? 100%. Good. 100%. 100%. Thank you. Melody, 100%. Masoti, 100%. Any other person? Somebody who got 80%? Good. 100%. I can also say 100%. Good. So we know that's 100%. 80,000 out of 80,000. So parent holds 100%. Good. That's the first thing. Then we have equity. Yeah. Then we have retained earnings 120 and 60. Good. Trade and other payables. Based on what you have seen so far, is there, so as you are reading the question and as you are going through the statement of financial position, you are thinking of what I am going to eliminate. You are thinking about it. So far, what am I going to eliminate? Tell me two things. What am I eliminating here? What am I going to eliminate? So that is how you approach a question. As you read a question, you're reading it carefully, you are underlining the important points, and you are thinking ahead. I'm doing consolidations. The most important thing is for me to know what I'm going to eliminate. What am I? Good. I'm eliminating investment and equity, investment. Good. What other thing? Okay. Good. Yeah, guys, you guys are brilliant. Good. So that is it. And I've traded and other payable. So already I can see I can get some easy marks here by just combining A and B together. Some easy marks here and there. By combining A and B together, even before they say stop work, I'm getting marks, right? Because I'm just adding the two. That is when I'm preparing my consolidated financial statement. Good. Then let's see. They said A Limited, the parent, acquired its interest in B Limited on the 1st of January. Guys, check this. Very important. This financial statement has been prepared as at the 31st of December. Meanwhile, I acquired this subsidiary on the 1st of January, right? Let's see. Let me see. When did I acquire it? Yes. So that means what? I've spent a whole year with this subsidiary. very important. So as you read the question, you are highlighting who is the acquirer, who has control, who is the parent, and who is the subsidiary. That's the first thing. Acquisition date. When was this subsidiary acquired? And 2, when was this financial statement prepared? When I read this question, and also when I'm reading it, I'm thinking about what I'm eliminating. I'm also thinking about my if I'm not told what my controlling interest is, I'm thinking I'm doing calculations. Okay, 80,000 over 80,000, 100%. Okay, this is a wholly owned subsidiary. Good. I move on. Okay, there's a liability, there's a equity I need to eliminate. There's investment I need to eliminate. So far, okay, already I've got a picture. I've got a picture of how my final answer is going to be in my head already. This 100% coming. 100%. There is no way you will go wrong. And then you read on to say, okay, so if this financial statement is at 31st of December and I acquired subsidiary on the 1st of January, that means I acquired it at the beginning of the year, and I've been with this subsidiary for a whole year. I've earned income for a whole year. From the 1st of January, I acquired it to the 31st of December when the financial statements were prepared. I've earned a whole year worth of income. Good. Then they tell me the subsidiary's retained earnings amounted to 44,000 at the time. This is a very important information. So if I look at my financial statement, my retained earnings, they tell me is what? It's 60,000 for the subsidiary. Meanwhile, when I acquired on the 1st of January, when I acquired the subsidiary, the retained earnings was only 44,000. That means I've moved from 44,000 to 60,000. That difference of that 16,000 is mine. Do you understand? The 44,000, I did not take part in the 44,000 because that retained income existed before I came to acquire the subsidiary. But the difference between the 44,000 and the 60,000, that 16,000 is mine. I made it happen because from that time to this time, I have acquired the company. Any questions before we continue? Any questions? Do you understand? Everything that is telling you in a question is very important. And it shows the understanding. It shows that you understand what you are doing. So when I acquired it, when I initially acquired the subsidiary, the retained earnings was 44,000. That retained earnings is not mine. I didn't take part in getting that 44,000. I'm not part of it. Because when I came to acquire B, that 44,000 already existed. The only portion that I am responsible for is the difference between the 44,000 at the date of acquisition and the 60,000 that now I've earned in retained earnings. So that difference of 44 and 60,000, the 16,000, that is what must go into the consolidated financial statement. Does that make sense? Melody, are you here with us? Do you understand this? Norma, are you getting this? MP, are you getting this? Good, sharp, cool. All right. So where are we? Yes. Assume that the carrying amount of the asset and liabilities of B Limited is equal to the fair value thereof at the date of acquisition. Later on, we will understand the statement, but for now, it's not so important. The reason why they have this statement in is that IFRS 3, which governs consolidation, states that when you acquire a subsidiary, the assets have to be, all the assets and liabilities have to be fair valued. Right? That's the reason why they have the statement there, but it doesn't matter. Then they also give us the statement of the profit and loss and other comprehensive income. So this is the first time we are seeing a financial statement where they've given us the statement of financial position and also the profit and loss and also the statement of changes in equity, which is coming after this. So look at the profit, an extract of the income statement or the statement of comprehensive income. Profit before tax, 35,000 and 23,000. Income tax, 11,000, 7,000. Profit for the year, 24,000, 16,000. Then there's no other comprehensive income. Then we have a total comprehensive income of 24,000 and 16,000. Does it make sense? So this is an extract of the profit and loss and other comprehensive income. Then we also have what? The statement of changes in equity, which is showing us the share capital and the retained earnings. So the balance at the beginning of the year was 100,000 for A, 80,000 for B for share capital. Retained earnings was 96,000 and for B was 44,000. Then there was no total comprehensive income movement during the year, so we put nothing. But let's look at profit for the year, which goes into retained earnings. We have 24,000 from A Limited and 16,000 for B Limited. So all this information that we have received so far are all these are the financial statements of the individual financial statement of A and of B, right? And because we are not at this point in time, every one of them were preparing their own individual financial statements. There hasn't been any elimination or anything, and every transaction they put there is valid, right? Whether they were doing it with a subsidiary or subsidiary was doing it with a holding company, it doesn't matter because it's their own individual financial statements, and therefore they are it's proper, it's good, and it's the right way that they should process whatever transaction that they have, even with their holding company or with their subsidiary as a proper transaction. Only when we are preparing for consolidation that we have to eliminate them. Good. Now, suppose you have to draft the consolidated statement of profit and loss and the other comprehensive income, the consolidated statement of change in equity, and the consolidated statement of financial position. So they've given us all this information, and they tell us that we should prepare what? The consolidated statement of financial position, consolidated statement of profit and loss and other comprehensive income, and the consolidated statement of changes in equity. And that is how your exam is going to be. You are going to prepare all of them or one of them. Either the financial position, statement of comprehensive income, or the equity. Either all of them or one of them or two of them. That is how the questions are set. Good. So we've read the question. We've highlighted. So we've spoken about that it's 100%. We've calculated. We know it's 100% equity interest. You guys mentioned to me that we have to eliminate the investment and equity. Is there any other thing we need to eliminate from what we have read, looking at the statement of comprehensive income and statement of change in equity? Is there any other thing that we need to eliminate? We only have 3 minutes. Is there anything that we need to eliminate? I can't see anything. Can you? Can anyone see anything? Is there any other thing we need to eliminate apart from the investment and the equity? I don't see any other transaction between the parent and the subsidiary. Let's look at the statement of change in equity. Supposing there was a dividend, you know the dividends, there was a dividend paid to the parent. You know there has to be a elimination, right? Supposing there was interest income coming from the subsidiary to the parent, there has to be an elimination. So any transaction between the parent and the subsidiary, we have to eliminate it. And what is the best way to know how to eliminate it? Pass the journal entry in the parent company, pass the journal entry as it would be in the subsidiary, and cancel them out. Make the debit a credit and make the credit a debit. And you are done. Good, cool. So it looks like there's nothing to eliminate. Now let's see. We do an analysis. This is an easy analysis because we have 100% control. Share capital 80, retained earnings 44, a total of equity of 124, 100% of it all to A Limited 124,000. There's no non-controlling interest because 100% holding. Purchase consideration 124,000. Net asset value 124,000. So there's no goodwill. Goodwill is 0 because I bought in at exactly the net asset value of the company at date of acquisition, which was 124,000. I paid 124,000. There's no goodwill. Good. Profit for the year 16,000. How do I know that this is the profit for the year? Someone must tell me. We have only 1 minute. How do I know this is the profit for the year? Was it given in the statement of? Was it given in the statement of profit and loss? I think it was given. Oh yes. So the 16,000 was here. So you see, it's the 44,000 retained earnings at the beginning of at the date of acquisition plus this 16,000 gave me the 60,000 as retained earnings in the statement of financial position for retained earnings. You see, so everything makes sense. At acquisition date, I had 44,000 retained earnings at acquisition, plus the income of the 16,000 I've earned from beginning of from 1st January until December gives me the new retained earnings of what 60,000. Why does it become a retained earning? Because it's the financial statement. Once the financial statement has been prepared, the profit goes into retained earnings. If it was a trial balance, it would be different. We'll be showing the profit separately. Does that make sense? Okay. This is my pro forma journal entry. Debit share capital 80,000, retained earnings 44,000, investment 124,000. There's no goodwill, so no goodwill is here. There is no non-controlling interest, so no non-controlling interest is here. So my financial statement becomes very simple. I just need to eliminate share capital of 80,000, eliminate retained earnings of 44,000, and eliminate investment of 124,000 to result in my consolidated financial statement. 35 plus 23, 11 plus 7 for tax. Profit for the year 40,000. My statement of change in equity 100,000 at the beginning of the year, 96,000, 40,000 for the profit. How did I get the 40,000? It's coming from the consolidated statement of profit and loss, the 40,000. Good. And then this is the balance sheet or the statement of financial position. Property 160, 180. Current trade and other receivable 11490. Equity share capital. It will only end up with the share capital of the parent company. Retained earnings 136,000. When we meet tomorrow, we will calculate the 136,000 just for me to make sure that you understand. Then we have trade and other receivables 178 and 130,000. Easy stuff. Go over it again. We will do question 2 before we start studying unit 5. We will do question 2. Question 2 has got everything for question 1 plus addition for plus goodwill. So look at it before you come in tomorrow. And whatever you don't understand, then you ask when you come. Good. I think we are done. Any question? One last question before we close. Anything that didn't make sense so that we can tackle it tomorrow? Anything? Okay. All right. Thank you, guys. It's been very, very nice. We are moving slowly but surely. We are getting there. Thank you so much. I really enjoyed it.